news and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London. Look, we are digesting a lot here. It's like drinking out of a fire hose. But I want to get immediately to the earnings stories because that's where you're seeing perhaps more of the volatility when it comes to this stock market, which is broadly green on the screen when you look at some of the futures, when you look at some of the how the European markets are trading. But Heineken is, I think, the story of the morning, down about 6.5%. It saw a bigger move to the downside earlier. This coming after an almost $1 billion impairment charge on its stake in a Chinese brewer. Now, they're saying this is a one-time technical impairment, but it's interesting because it's coming off of potential concerns that you are seeing in that Chinese consumer market. This is a theme we hear over and over again for a lot of the European heavyweights. LVMH is a great example of that read-through. It's not all doomsday, though. Philips, for example, showing the exact opposite story, higher by 11% this morning, putting up some very good new orders when it comes to their bottom line. So you are seeing the shares rally there. And then Reckitt, another downside mover. This is actually one of your biggest weights on the FTSE 100, kind of counterbalancing the outperformance you saw in the oil market as well. This comes, the share move, I should say, is by about 9%, just shy of 9%. This comes after a U.S. court ordered Abbott Laboratories to pay about $495 million in damages over claims that its baby formula caused an infant's bowel disease. Now, there's a lot to digest there. It's a very complicated story, a very tragic one as well, but the share is certainly responding to that this morning, down to the tune of about 9%. Now, again, that is the earnings story. There's plenty going on in the economic space as well, because in addition to all of the earnings on both sides of the Atlantic, you've got the BOJ, the Federal Reserve, the BOE, plenty of economic data kind of sparse through it all. Let's dive into that part of the story. I'm joined now by Katharine Neiss, Chief European Economist and Deputy Head of Global Economics over at PGIM Fixed Income. Katharine, there's so much to digest. I don't even know where to start with you. But I think for me, when it comes to the central banking story this week, it feels like the BOJ may be the biggest surprise or the biggest kind of market mover. What for you is top of mind?
I agree. The Bank of Japan, it's a bit of a tough call. And I think the expectation that they could be raising interest rates there further above zero lower bound, combined with making an announcement on their balance sheet, which they've told us they will do, has the feel of a sort of double whammy surprise that, I think you're seeing shades of that in the foreign exchange markets. But, of course, there's a risk then that they underwhelm in terms of the decision later this week. So, yeah, all to play for.
Well, so I think this is something that a lot of people talk about when it comes to the Japanese in general, is that when it comes to monetary policy, they've been such a kind of experimental on the monetary policy front, but experimental where almost every other central bank in 20 years later catches up and ends up using some of that policy. And I'm curious, this is kind of my big picture nerdy question here. What from the BOJ are we seeing right now in terms of import prices, the capital flows in terms of the yen as a haven currency, even the fact that they have an aging demographic? These are all themes that you're seeing in the United States, for example. What can we learn here from the BOJ that might apply to the Fed in, say, 10, 15 years?
It's true. The Bank of Japan has been very much on the frontier. And as you say, they were dabbling in these exotic tools that ended up being tools that were deployed by other central banks. But I think actually right now, the Bank of Japan are actually learning and watching from other central banks. So it is a little bit flipped in the sense that they're raising rates much later than the other central banks. If you just think back to when central banks in the euro area or the U.S. started raising interest rates, nobody could imagine that rates could go as high as they did and that economies could withstand that. Maybe that gives the Bank of Japan a bit more comfort in terms of raising rates perhaps sooner than otherwise expected. Similarly, on the balance sheet, what we saw is that other central banks, including the Fed, the ECB, Bank of England, were shrinking their balance sheets far sooner in the hiking cycle than I think we would have imagined, just a few short years ago. And again, I think the Bank of Japan is following that playbook, and that's why they're saying, look, we're going to tell you something about our balance sheet. So I think actually right now, maybe they're learning from others.
That's fascinating that you say that the dynamic is flipped as well, because on top of all of that the monetary policy has to deal with, then you have this fiscal spend as well. And you've actually seen fiscal spend kind of push a lot of countries to outperform. And I'm pointing specifically, of course, to the United States with the Inflation Reduction Act, but you see it in Italy, you see it in Spain, you see it, I'm going to put Greece in there as well. And of course, they all have their own complicated dynamics. But where you don't see it is in the UK, and you don't see it in France, because both countries are really dealing with this fiscal headroom that doesn't really exist. And we're going to get comments later today from Chancellor Rachel Reeves about that very issue in the UK. I'm curious about your take on that. How much of that is a concern that fiscal policy cannot be used for the likes of the UK and France?
So I think the situation between the UK and France is a little bit different. In the case of the UK, near term, the fiscal situation doesn't look good, and I think that's very much the message we're going to get from Chancellor Reeves today. But I think the UK is going to have a sort of swallow the frog approach, I call it, in that they're going to get the fiscal pain out of the way right up front in order to create that fiscal space later on, both because they front-loaded the consolidation and because the reforms can perhaps generate growth, and by front-loading that fiscal pain, it gives the space for the Bank of England to cut rates, which itself, creates fiscal space later on. So I think although near-term the fiscal picture doesn't look great, potential for fiscal space later on and therefore growth prospects is better, is potentially not so bad for the UK. The situation in France is very different. There is no sign whatsoever that they are, going down a fiscal consolidation path. Where we're seeing fiscal deficits shrink in France is because energy subsidies are rolling off, for example, and because the economy is a little bit better than it was. But no sign of fiscal discipline. And the huge fragmentation we're seeing there, which we're not seeing in the UK, means that the prospect of reforms or consolidation going further doesn't appear to be very bright. So I see them as being on quite different fiscal paths.
It's fascinating, especially given we're talking about this French bond market and the spreads remaining so elevated relative to, the likes of Spain and Italy. I keep bringing it right back because we've heard so many market commentators say that the periphery is actually looking like a stronger credit right now than the core, and which, again, is insane to me, because these are the very countries that were blamed for the European debt crisis in a lot of ways. I'm going to stop nerding out and talk a little bit more about the some of the volatility that we are seeing in that bond market as well, because, yes, we have that fiscal story in France, but I'm curious whether it even makes a difference right now, especially given some of the data that we've gotten. We're starting to see kind of cracks in the consumer story. We talk about it in the cracks of China. The United States starting to flag a little bit as well. And then you got that hot PCE number, and I'm curious what you think of that.
So we're going to get GDP data for the euro area this week. We're going to get flash inflation data for July. I think people are going to be looking for evidence that either things don't look as bad as maybe the flow of data from the last couple of weeks seems to suggest for Europe, or it's actually going to confirm this weaker picture. And I'm very concerned, because very simply put, the forecast for the euro area was that domestic demand was going to pick up. We were going to see consumers coming out and spend. We were going to see firms wanting to invest. Now we can layer on this election uncertainty that we have in France that also poses risks, I think, for leadership at the European level. So it goes beyond France. And in fact, we're seeing that in some of these early survey indicators where they've dropped off even in countries like Germany. So this is not really an environment where you're going to see consumption picking up or investment picking up. And therefore, you start to question, how strong is this cyclical recovery that we're seeing in Europe? And, that's the thing where I'm just not sure the market's quite pricing in. For example, cuts when we get to 2025 could be, more aggressive than I think what we're currently seeing if this data flow keeps looking as weak as what we've seen in the last couple of weeks.
So the manufacturing sector in Germany, of course, has been kind of the Achilles heel, it feels like, of the broad European economy. You're right to point out the French geopolitical overhang of this as well. But I'm curious about if you could expand a little bit on how that extends to the broader European continent. Like, what is in terms of the leadership issue, what cracks could emerge, or what is the market not paying attention to, given, to your point, we got a really poor IFO number last week as well, perhaps one that surprised even the kind of survey itself. I'm curious how that shows up on the broader continent as opposed to simply being a core European story.
So it kind of comes back to the points you made around the periphery and how strong they are, and the fact that markets like European unity. Markets like it when European political leaders agree programs that further and strengthen European integration, because that has generally led to very strong growth within and across the European Union. We saw that in the pandemic with this agreement of these next generation EU funds that have essentially locked in grants and preferential loans to the periphery and just completely changed the growth outlook in those regions. We need to see more things like that, because in a world going forward where regions become more inward looking, I mean, the EU is a huge economic, it's one of the three, largest economic regions globally. Germany has 7 times more exports to the rest of the EU than it does outside of the EU. Yeah. So if that thing is strong because of deepening integration, then that will help and spill over and have positive impacts on all the regions in Europe.
So it's the curse of the uneven recovery, it sounds like.
Exactly. And the difference now to what we had, say, 10 years ago is the risks within the EU are not fragmentation and redenomination risk, which is what we were worried about, say, 10 years ago. Yeah. But it's really about fundamental growth drivers within Europe, and that hinges on integration. And without French leadership, it's harder to see that happening.
Certainly something we're going to be keeping an eye on. Katharine Neiss, Chief European Economist and Deputy Head of Global Economics over at PGIM Fixed Income, talking to us about that unity story. It's certainly one we're going to be keeping a very close eye on. And I'm going to stick with the geopolitical story. Coming up on the program, Israel attacked Hezbollah targets over the weekend, threatening further retaliation for a rocket strike. Fears rising around further escalation as a truce in Gaza remains on the line. We'll have the latest next. This is Bloomberg. Welcome back to The Pulse. I'm Kriti Gupta in London. Now, Israel is threatening further retaliation after striking Hezbollah targets in Lebanon. It comes after a rocket attack that killed 12 young people in the Israeli-occupied Golan Heights. Hezbollah has denied responsibility for the attack. Let's bring in Bloomberg's Jumana Persechi joining us out of Dubai. Jumana, bring us the latest.
Yeah, that's right. So this marks the biggest escalation in northern Israel we've seen since October 7. The attack at Majd al-Shams in the Golan Heights over the weekend killed a dozen 10 to 20-year-olds. They were on a football pitch, wounding more than 40 others. And IDF and both U.S. intelligence have said that Hezbollah were behind the rocket attack. Hezbollah denied responsibility for the attack, but intelligence suggests that the rocket and the specific make of the rocket that was fired could only have been launched by Hezbollah. Now, the Israeli Prime Minister, as you know, was in the U.S. last week. He had to cut short his trip. He flew back home earlier than anticipated, met with key security officials to discuss the likely response. And over the next 24 hours, it will be key to see in what shape the reprisal is going to come. There is an expectation that there will be some form of retaliation from Israel, but news outlets are saying that it will be, quote, limited but significant. There does not seem to be a desire to engage in a full-blown conflict. And indeed, the Lebanese prime minister now is looking to de-escalate as well, calling for a ceasefire on the southern part of the country. This, of course, with the view that there are ongoing talks taking place that took place in Rome over the weekend, discussing a potential ceasefire deal in Gaza. And the representatives from Israel, the U.S., Egypt, and Qatar all at that meeting to talk about how we get that ceasefire proposal across the line. One of the sticking points has been how you move from a truce to a permanent ceasefire. But the fact that those negotiations are still underway is a positive sign and is one perhaps signal that if this truce does get agreed to, then we could see a de-escalation of tensions across all of these fronts in the region.
All right, Bloomberg's Jumana Bersechi joining us out of Dubai on the latest in the Middle East. We thank you so much for that crucial context. And from the Middle East, we go to South America, where Venezuela's electoral authority, which is controlled by the ruling regime, says Nicolas Maduro has been reelected as president for another 6-year term. Now, the opposition has rejected the ruling, calling on the military to intervene. The United States and some Latin American neighbors have also raised concerns. We'll bring you the latest on that story as we get them. Coming up on the program, however, we switch right back to the earnings story. Automakers facing some pretty strong headwinds. We look at what we expect as earnings season continues to ramp up. Stick with us. This is Bloomberg. Now, we are knee-deep in earnings season. In a moment, we're going to look at what to expect from car makers and big tech companies reporting this week with Tim Craighead from Bloomberg Intelligence. But first, I want to talk about Heineken here. Shares in the world's second-largest brewer slumping after announced a one-time impairment of more than 870 million euros, almost $1 billion. That's for its stake in China's biggest brewer on concerns over consumer demand. I want to bring in Bloomberg's Dasha Afanasieva, who's been, of course, covering the story all morning. So this is a one-time thing, or at least that's what they're saying. But this is connected to those concerns around the Chinese consumer. How seriously do we need to take that broader macroeconomic read-through?
Morning. I think for Heineken, it is concerning because we have been hearing about the premium consumer particularly being under pressure in China, and there's a slowdown in the macro sense. And also in Heineken's case, the initial acquisition was pretty pricey. It was a $3 billion deal back in 2018, which was close to spirits valuations back then. So it's worrying to look at this market that had great promise, and Heineken did this bet where they didn't have to produce themselves, but then they did this tie-up with the local manufacturer, which was supposed to be easier politically. And it seems like that bet isn't paying off now in a environment where other markets are also under pressure, particularly the US.
It's an interesting dynamic. And Tim, I want you to weigh in here because, of course, you're talking about this from a different sector point of view, the automakers. And I think that the line to be drawn here is that if we're talking about weakness in China hitting like Heineken and others, is that the same story for automakers?
It's part of it. And don't forget, we saw weakness with LVMH carrying others in the luxury goods industry. That plays over into autos in that it's one of, I think, 3 issues that our autos team is quite focused on. One clearly is China. And in the auto sector there's just intense competition with BYD ramping up production, overtaking Tesla, and it's putting pressure on the likes of VW, BMW, Porsche, Mercedes. They get 20+% of sales from China, over 30% of their profits likely from China, and so that's a big deal. So you have that. You have the transition to EVs, which now seems to be a bit of a pause. And you've got incentives that are rising in the U.S. So the likes of BMW and VW both have headwinds that we'll hear about more when they report their earnings.
And that's of course, a sector story, and you broadened it out for the entire automakers. Dash, I want to bring you back in here because even today, when we talk about this as a Heineken taking a hit and the China read-through broadly that Tim was just talking about, Carlsberg is also taking a hit, down about 4% on a day that the markets are doing really, really well. So is there a read-through then to other beer makers?
Definitely. Carlsberg is quite exposed in China, and earlier this year it said there was actually going to be investing more in countries like China. And that's sort of the engine of growth. That was supposed to be the spark of hope. In an environment where other markets are also under pressure. You had a year last year where prices went up a lot, and consumers are really at their limit, I think, across all sectors. We've written about this also in luxury and autos. So it sort of begs the question, well, if you're not going through price, how successfully are you able to pivot to growing through volume? And so far, with this results season, it seems like consumer sectors across subsectors are disappointing on that front.
Yeah, it's a really fascinating topic. And the fact that the Chinese weakness is no longer being able to be kind of counterweighted by the U.S. story is fascinating. Bloomberg's Dasha Afanasieva and Tim Craighead, our consumer reporter and director of research at Bloomberg Intelligence, respectively. We thank you so much. So we've covered the beer makers. We've covered the automakers. Coming up next, we're going to dive into the financial sector. Our exclusive interview with 10X Banking founder and CEO Antony Jenkins next. Stick with us. This is Bloomberg. Good morning and welcome back to The Pulse. I'm Kriti Gupta in London. Let's get to your top stories this morning. The big rotation about to be tested as earnings from the biggest companies on both sides of the Atlantic are coupled with rate decisions out of the Fed, BOE, and BOJ. And speaking of those earnings stories, we're already starting to get some Heineken shares tanking this morning after a near $1 billion China impairment. But Phillips surging as new orders rise for the first time in 2 years. Plus, on the geopolitical front, Israel attacks Hezbollah targets and threatens more retaliation for a deadly rocket strike. Fears growing of further escalation as talks continue for a truce in Gaza. Now, there's a lot to digest here, from the geopolitics and the monetary policy to the earnings story as well. But I want to take a moment and talk a little bit about fintech. 10X Banking is today unveiling what it calls the world's first, quote, meta core, a software product to help banks work towards full digital transformation. It, of course, comes after the company's successful $45 million funding round earlier this year, amid rapid growth in new online banks and fintechs challenging some of those traditional institutions. Now, Revolut became the latest startup to win a UK banking license just last week after first applying all the way back in early 2021. Let's just go ahead and bring the founder of 10X Banking, CEO Antony Jenkins. An absolute pleasure to have you on the program. Thank you so much for coming in.
Good morning.
Good morning. Walk us through what you do here. For the folks that aren't watching fintech and watching the developments there, why now? What is this? How is it going to change the world?
Well, as many of your viewers know, I spent 30-odd years in the banking industry, and I was always incredibly frustrated with the technology I had to work with. So 8 years ago, I set up this business to provide a set of technologies that would enable banks to be able to transform themselves and remain relevant in a fast-changing, competitive world. And today we're announcing the MetaCore, and the MetaCore really has two capabilities that helps banks that serve everybody from an individual all the way up to a multinational to deliver products faster, cheaper, use AI more effectively. And that really consists of two things. Firstly, a very powerful ledger. And the second is a set of technologies that allow you to build product very quickly. And we can build product so fast, it's 10,000 times quicker than doing it using traditional technology.
And we should just point out, and I should have started off with this, you're, of course, the former CEO of Barclays. Yes. And we should just point that out first for our audience who may not recognize you if they're just waking up or haven't had that first cup of coffee. But talk to us about adoption here, because this is something that, to your point, has been, of course, a long time in the making for you, but a long time in the making for the banking industry as well. And I'm curious, when we talk about things like cloud and AI, even things like cloud has been in the works for 20 years, but adoption is still kind of slowly ramping up. How long for this to be widely adopted?
So management and leadership within banks is rightly conservative. But what we're seeing now around the world is two things. One, a recognition that things just can't go on the way they are. And secondly, a recognition that the technologies have finally arrived that allow this transformation. If you go back 20 years, your choice as a bank CEO or board was really to go on a 5, 7, 10-year, multi-billion-dollar journey, which was high risk. Now we can offer a journey that's measured in months and measured in a few $1 million to create real change inside the organization. So the time has come for this technology, and there is a massive tailwind out there. Adoption is going to really take off in the coming months and years. So
let's take a step back here in terms of the fintech space. So you've explained the product here. There's a lot of innovation here, and I know you can't speak to regulation just because of other roles that you hold. But I'm curious, when it comes to things like banking license and stuff, do you think there's a hesitation right now to dive right back in to the fintech space. And I say this because of these kind of ups and downs you've seen in fintech, not just in terms of banking. You've seen it in the crypto industry, you've seen it in AI as well. Do you think there's a hesitation, especially in this part of the world, to dive into kind of that new innovative technology?
You know, I've been around so long that I can see the cycles now. And fintech, of course, is not one thing. You've got providers like ours, which really are kind of B2B2C providers. You've got straight B2C providers, neobanks and so on. You've got crypto. You've got a whole range of technologies, a whole range of products and services. And what we see is, as always, you know, the old cliche about predicting the future, we tend to overestimate the short-term impact and underestimate the long-term impact. Fintech's been around now for, 10, 15 years? We went through a big dip in the industry. I saw that back in the 2000s after the first dot-com boom. You know, and then it came back, and it came back much stronger. And I think we're now at that point of the cycle where these technologies are really starting to season and mature and to come back and power back. And that's why what we've built, we have, you know, with our clients, who are banks, we've got millions of their customers using our technology now, and that's going to be tens of millions and hundreds of millions in the coming years.
So much of that appetite, though, that you're talking about fintech and this innovation, it feels like it might be coming from the excitement you're seeing in the public markets. Forgive me, I'm getting very nerdy here, but it feels like with the excitement around the likes of NVIDIA or Apple or Meta or whatever that is, you were starting to see this massive, of course, trillions of dollars that these big cap tech companies are sitting on suddenly deployed into this R&D space. But I'm curious if the macroeconomic environment switches and suddenly that money is not as easily deployable. Do you still see that excitement showing up in fintech?
Yeah, I do. I mean, I think you've always got the sort of long-term trends in the sector, and then you've got the ups and downs of the finance market, and sometimes those things coincide and sometimes they don't. As you well know, we've had what is in this time a relatively huge spike in interest rates. Now, historically, interest rates aren't that high. But of course, that did dampen down some of the attractions of you know, VC investing and so on. And we saw that affect the fintech market. But things will come back because at the end of the day, you've got two things going on. You've got very powerful trends that are powering these businesses forward, and you've got the ever-increasing power of technology. Now, 24 months ago, most people hadn't heard of ChatGPT, but it made AI real for people. And so now banks are focusing heavily on how can we deploy AI. But it's very hard to deploy AI if you can't get at the fundamental data. You need massive amounts of data to train the algorithms. And if that's fragmented across many legacy systems, it's hard to do.
So I think you're the great person to talk about this, especially right now, because yes, we have the technology space as well, but especially in Europe, we're talking a lot about things like cross-border consolidation and specifically consolidation in the banking space as well. How does that either help or hinder what you're talking about here?
I think in some ways there are two things which are sort of running along on different tracks. There's always been consolidation in the banking industry. Like all mergers and acquisitions, you know, some of them work, some of them don't. And I think there's been less of that since the great financial crisis, frankly. We may see some more of it. But actually, the fundamental problem that a bank faces, whether they're an individual or a product of an amalgamation, is the same, which is I need to serve my customers better. I need to get product to market faster. I need to bring my costs down. I need to be able to use AI to create competitive advantage. Those things remain the same. And it's incredibly difficult to do that if your technology is 10, 20, 30, 40 years old.
Are you partnering at all in the alternative space with private markets? It feels like there's so much investment coming from your biggest PE and private credit firms out there. How are you interacting with them?
Sure. I mean, there's a huge amount of money. We talk about this money sitting on the sidelines in the industry, and it's provided firepower for the growth of the fintech industry over time. And that money continues to be there and continues to be available to firms that are successful. You referenced our funding round at the start of the year, which is proof that if you've got a good business, you can raise money, and that's important. Of course, we're at that point in the cycle, again, going back to the early 2000s, where the wall of money that went into the dot-com boom, the wall of money that went into fintech, that stopped. But actually, my view is you build better businesses in this part of the cycle because you have to be much more disciplined in terms of what am I offering my customer? Can I make money out of it? How much capital do I really need? And that's forcing businesses like ours to become very, very efficient and effective. Now, of course, I've been in business for a long time, so that was always how I ran my business. But, it's actually good for the industry because the survivors are going to be very successful.
Let's talk about the IPO market. I imagine at some point you will have your eye on and consider what might be available to you. Would you IPO in London or New York?
Well, it's a good question. And firstly, the question before that is, would you IPO at all, right? And that's where you've got to think about, to your earlier point, can I get capital from the private markets? Do I need to go public? If I go public, and I talk to founders about this all the time as somebody who's run a public company, don't forget that the day you go public, the day you ring the bell, your life changes forever, right? Because
fair enough.
Instead of focusing on building your business day in and day out, you're going to spend a lot of time with your investors, as you should do, right? Now, we know, and it's just the fact, that the US has become a more attractive environment for technology-driven companies to raise money. That's just a fact, right? And there's many things that underpin that in the UK, that make the UK market less attractive. A lot of it is to do with, frankly, just size, but also liquidity, the amount of money our pension funds put into UK-listed equities and so on. So, I would always make a decision, and my heart would say UK, but my head would evaluate the options, and I'd go, frankly, where I could get the best return for my shareholders.
And you think that's New York at the moment?
I think we just look at the data, right? I think the data does favour New York, but I'm not saying I wouldn't raise money here. I mean, I'd love to raise money here. Conditions would have to be right, though, and I think if you ask any founder, any CEO, that's what they're going to do, because they're going to do the best thing for their shareholders. And so whatever we can do to make the UK more attractive, we should.
All right, Antony Jenkins, we have to leave it there. A very diplomatic answer on your part. We look forward to having you back very, very soon. The founder and CEO of 10X Banking, and of course, the former Barclays CEO as well. We thank you so much. Coming up, we go into the U.S. political space. Donald Trump calling for the United States to become the world's crypto capital. Our big take on his journey from skeptic to Bitcoin cheerleader. We're going to dive into the details next. This is Bloomberg. Vice President Kamala Harris raised $200 million in her first week as a 2024 presidential contender, highlighting the surge of enthusiasm among Democrats for their new presumptive nominee. For more on this, let's bring in Bloomberg's Europe executive editor, Chad Thomas, who, of course, has his one eye on what's going on in U.S. politics. Chad, $200 million. I mean, that's not chump change. I think 66% of it was actually coming from first-time donors. So it kind of feels like it's putting to rest some of the thought that she's just inheriting Biden's pool of campaign money. How much of that is true?
Yeah, hi, Curdy. Good morning. It is very interesting that $200 million coming in just the last week. Of course, it's only been a week since Harris became the presumptive nominee. To put that into perspective, the Biden campaign coffers were under $100 million when she took over. So now she's at about $300 million, tripling the amount that she has. As you said, many of those first-time donors. It shows the excitement within the party. The Republicans, though, did outraise the Democrats in the second quarter of the year. What does this all mean? It's going to be a very expensive campaign season as we head toward the November election, with just a bit over 100 days left now until the election.
Talk to us about the polling numbers here, though, and a lot of, I feel like, political strategists are calling this the honeymoon phase for Kamala Harris when it comes to polling, which is ironically what we also hear around the Labour government here in the UK as well. Walk us through when we're going to perhaps see polling numbers that are maybe taken a little bit more seriously from the political community.
Yeah, it definitely is what one would call the honeymoon phase. Many pollsters are saying that things are likely to settle by the time we get past the Labor Day weekend. That, of course, is sort of the official end of summer for Americans, and that is when the campaign really gets going in earnest and people are following it more closely. But some positive news for Kamala Harris: when we look at the key swing states that the Democrats have to win if they want to recapture the White House, Wisconsin, Michigan, Pennsylvania, those states seem to be slipping away when Biden was still the candidate. The polls that have come out at the end of last week and over the weekend showed those three states are basically tied. Some have Trump barely ahead, some Kamala Harris barely ahead, but they have really pulled in. And if they're going to win, they have to be able to capture those states.
All right, Bloomberg's executive editor for Europe, Chad Thomas. It's fascinating. I feel like as Americans on this side of the pond, we're watching it kind of like with a tub of popcorn. We thank you so much for joining us this morning with that crucial
I'm from
context.
Wisconsin, so I'm watching it very closely.
Well, there you go. Swing states. I'm from Texas, of course. It's very exciting. But I got to say, when we're talking about the Kamala Harris campaign, let's also talk about the Trump campaign as well, because that's where you're starting to see some interesting market dynamics, specifically when it comes to Bitcoin, which touched a 6-week high after Donald Trump gave a speech expanding his pro-crypto agenda. I want to get a little bit more on the story, connect some of the dots between the U.S. political space and the alternative space, and bring in our fintech reporter and crypto reporter, Emily Nicole, joining us this morning. Emily, what a turnaround for Donald Trump and his take on crypto. Walk us through it.
Yeah, when he first took office, he thought that Bitcoin was, a part of a criminal enterprise. It had no intrinsic value. And now look at where we are. He's making it a cornerstone pledge of his campaign to make Bitcoin and the US, the crypto capital of the world. He wants all Bitcoin in future to be mined in the US. He'll set up an advisory council, and he's promised to introduce a stablecoin framework as well. So there are a lot of key campaign promises going on here for crypto. And for him, it really isn't about face. He launched a collection of NFTs not that long ago. So, appealing to this industry is something that Trump is really trying to do as we get closer to November.
It's really fascinating because, again, Trump is specifically appealing to a party. I mean, the Republican Party is a largely populist party. It's even in other spaces, it's one that is seen as deregulating or not even really against centralizing a lot of that power. Those are the very concepts, not only behind the crypto industry, behind the meme stock industry as well. Is that the logic there? Is that the read-through?
The crypto industry itself, I think, has faced a lot of persecution over the last few years. That's how they see it. They see the SEC in particular as a regulator that's been very heavy-handed with them. And Trump has promised, if he does get elected, that he would fire SEC Chair Gary Gensler. Whether or not that's something he has the power to do, we're not sure. But, that's what he's promised. And so that has gone a long way to appealing to the crypto industry, because the US is the largest crypto market in the world. It's somewhere that a lot of crypto companies haven't felt comfortable operating in for the last couple of years. And so this really represents a change in tone and an access to a key market that wasn't there before.
It's fascinating that this is actually proving to be kind of almost a fundraising and a point of rallying as well, quite literally marrying the markets with the politics. Bloomberg's crypto and fintech reporter Emily Nicole there, bringing us up to speed on that story. You can check out the big take as well. It really dives into some of the details as well, available, of course, on the terminal and online. Now, coming up on the program, we're going to switch to a little bit of geopolitics here. From Italy to China, Meloni's mission to mend ties after ditching China's flagship Belt and Road Initiative last year. The Italian prime minister is in Beijing with a pledge to rekindle relations. Now, what does that mean? We're going to dive into the details next. This is Bloomberg. Welcome back to The Pulse. I'm Kriti Gupta in London. Italian Prime Minister Giorgia Meloni is pledging to restart bilateral cooperation with China. She's on her first visit to Beijing since snubbing the nation's flagship Belt and Road Initiative last year. Let's bring in our Asia government and economy correspondent Rebecca Chung-Wilkins all over the story in Hong Kong. Rebecca, walk us through why this is such a big deal.
Well, it's a big deal, really, for both China and Italy. But for Italy and Giorgia Meloni, this is the first time she's heading to China since Italy pulled out of the Belt and Road Initiative and ruffled a lot of diplomatic feathers. In fact, joining it, the only G7, the only NATO country to join the BRI, and then pulling out, really essentially because, she said that Italy wasn't getting enough out of membership into the BRI. So this trip is really about trying to sort of relaunch, reinvigorate China-Italy ties and get that strategic partnership, which has been going on for more than 2 decades, back on the road. They have signed this 3-year agreement to cooperate on a wide range of things, everything from trade, education, food security, environment. And from Meloni herself, there has been this emphasis on asking for fair trade and fair practices. So certainly a sort of charm offensive from Meloni. She's quite a delicate act for her to sort of tread.
And Rebecca, very quickly, like 20, 30 seconds here. Is this a Giorgia Meloni story or is this a broader European story? How much of the two are interrelated?
I think the EU is a big part of this. Meloni sees herself as someone who can be this counterpart to China, not just when it comes to the EU, but broader issues like the Middle East conflict, like Russia's war in Ukraine. And so she sees China as another negotiator, neutral negotiator that can be sort of responsible along and on the world stage, particularly if we see Trump returning to the presidency and that pullback in support from Ukraine. So this is very much not just about Italy, China, but a sort of global partnership for Meloni.
All right, Asia government economy correspondent Rebecca Chung-Wilkins in Hong Kong talking about that dynamic there between China and Europe. A crucial story, of course, that we're going to be following as Giorgia Meloni continues her trip. I want to bring the story right back here to Europe, and specifically in France, where AFP is reporting this morning that French regional fiber networks have been sabotaged. Meanwhile, the country's rail services expected to return to normal after the network was attacked by as yet unknown perpetrators ahead of the Olympic opening ceremony. Let's go straight to Paris and get the latest with Bloomberg's Caroline Conan. Caroline, for a second there, it felt like all the disruptions were in the rearview mirror, and then we get these headlines. Bring us the latest.
Another act of sabotage, this time affecting the fiber networks, as you mentioned, in regional places, 6 departments, mostly in the southeast of France, around Marseille, Lyon. But Paris has not been affected. That's again according to AFP. We don't know exactly the perpetrators, but this comes on top of the sabotage we saw on the SNCF rail network on Friday, which affected a service to the north, east and west of France. As many as 800,000 passengers were affected going in and out of Paris, most of them, of course, either going on holidays or coming to Paris for the Olympics. Other than that, the only other hiccup we saw over the weekend was the quality of the Seine River, the quality of the water for the Olympics, with the triathlon training cancelled on Sunday because you had heavy rain on Friday and Saturday, which affected the quality of the water. But organizers of the Paris 2024 Olympics are pretty confident that the competitions will go underway, given the weather has been improving over the past few days. And this is very important, of course, because the French authorities have spent $1.5 billion on this in order for some swimming competitions to take place on the Seine River.
Well, so much for Anne Hidalgo's dip into the water. Bloomberg's Caroline Conan in Paris, we thank you so much for the latest. In the meantime, I want to get a quick check on these markets here because you are seeing weakness when it comes to the European currencies. Euro dollar is at a 108.33. You are seeing cable at 128.14. The weakness is continuing as the session goes on, but strength into the Japanese yen. This is interesting ahead of the BOJ. Of course, want to keep you apprised of that, as well as the oil price as we kind of digest some of those geopolitical headlines. An 81 handle that we are seeing on Brent. Look, we're going to digest all of this kind of as we get really geared up towards the New York market open. How much of New York trading takes its cue from Europe? Up next, Bloomberg Brief with Danny Berger and Manus Cranny. Stick with us. This is Bloomberg.